The Rebel Capitalist Show, episode 18. It gives me a great deal of pleasure to bring someone to the Rebel Capitalist Show that I have a tremendous amount of respect for. He's one of the few YouTubers out there that I think really get it. His name is Marko, and his channel is Marko Whiteboard Finance. So Marko, welcome to the Rebel Capitalist Show.
Mr. Gammon, how are you, sir? Thank you for having me.
I'm doing extremely well. So for some of my viewers that might not know who you are, or they might not have seen your channel, can you give us a bit of a background?
Sure. So born and raised in Northeast Ohio, big Cleveland sports fan, graduated from the University of Akron with the finance degree. Been interested in the markets or some form of entrepreneurship ever since I was a little kid, and started trading when I was about 18 years old. That was 2006. And a lot has changed in those 14 years, to be quite honest with you. So got my finance degree. I graduated in December of 2010 into one of the worst recessions and unemployments in American history, almost 10%. And I actually ended up selling cars with a finance degree for my first big boy job out of college. After that, went into tech startup, went into a little bit of sales, commercial real estate for a few years, went into capital markets, commercial mortgage lending, and then finally my last W-2 job before I went on YouTube full-time was here as a credit analyst at a publicly traded bank in Cleveland.
Okay, so I think that's really interesting because a lot of the young people in finance right now, they're not young enough to have experienced a recession. None of them are young enough to experience inflation, but that recession or that big crash that we have. And I think that that just leaves such a scar on people's memory, and it transforms the way that they think about risk on a moving forward basis. But you're a young guy, but you're just old enough to have experienced that. What was your experience like going through that 2007, 2008, 2009 period?
Yep. So like I said, I started investing in 2006, just old enough to get my teeth kicked in 07, 08.
Exactly.
So it's kind of funny. That's a very astute observation you made, George. So I feel like if you're under the age of 30, you've only ever invested in equities in a bull market, about 10 and a half years now. So to answer your question, it was a big wake-up call to realize that I'm not a financial genius and I'm not some stock market guru. Even though a lot of people feel like that today if they've only been investing for about 10 and a half years. I feel like that if you're a blindfolded monkey and you threw a dart at the S&P 500 over the past 10 and a half years, you're probably making somewhere in the neighborhood of 15 to 40% over these past 10 and a half years. With that being said, I still have been investing throughout this unprecedented bull market, just because I've always been infatuated with, publicly traded companies and burning the midnight oil and looking through all the different financial reports to find some sort of value or price discovery. However, which a lot of your channel talks about, and I have great admiration for you by peeling back layers of the onion, I feel like assets are pretty overinflated right now. So most of the investing that I'm doing right now in equities is definitely in a tax sheltered or a retirement account. I'm just kind of leaving my, my own private portfolio, just chilling, if you will. I'm not really making too many moves in that.
How do you think that reshapes your thinking as an investor to go through a crash? I mean, how do you think that's made you different when you look at not only upside, but downside?
Yeah, it just goes back to that famous Warren Buffett quote of being fearful when others are greedy and greedy when others are fearful. Right now, I'm definitely, I don't want to say I'm sitting on the sidelines because I am investing in my SEP IRA and other tax sheltered retirement accounts. However, to answer your question, it always lingers in the back of your head. You're sitting here seeing crazy gains in 2017, crazy gains in 2019. 2018 was relatively flat. But for the most part, you're seeing all these crazy gains, and you're seeing big market caps like Tesla just shoot up like a biotech penny stock. And you're thinking to yourself, what's going on here? And you have flashbacks to 07, 08, and it kind of keeps you a little bit hesitant to jump in the pool, if you will.
When you're analyzing a business or a stock from the bottoms up, and I always am fascinated by this because I'm such a top-down guy, and I understand that very well. But from really getting into the nitty gritty with a balance sheet or P&L, I don't do much of that at all. And so you talked about price discovery. How does that work when you're analyzing a business when we've got artificially low interest rates, and interest rates are the cost of money, and money is one half of every single transaction? Like Jim Grant says, that the Fed has put us into this financial hall of mirrors. So how do you take that into an account when you're analyzing a company or a stock from a bottoms-up approach?
Yeah, that's a great question. So typically, let's just say we're having this interview in 2014, for example, instead of 2020, with zero interest rate policies, et cetera, et cetera. What I would typically do is, again, I read Intelligent Investor. I come from that old school kind of value investing background. That's what my main portfolio pretty much comprises of. But ultimately, you're kind of looking at the jockey, not necessarily the horse. So you're looking at the management team. You're looking obviously at financials. The key ones are obviously PE ratios and things like that. And now PE ratios, I feel like every company that you want to invest in, they're way over 20, way over 25. So I feel like everything is just a little bit expensive. And you have to keep in mind that there's a big difference between price and value. And as a value investor, classically or historically, I'm just not seeing a lot of it. But just to elaborate more on the question that you asked, always look at the management team, always look to see if you can understand the business. If you can't understand the business and explain it to a 5-year-old cousin or a 5-year-old sibling, then you probably shouldn't be investing in that company.
Absolutely. And I think so many people forget that, Marko, when they're looking at it's weird. They look at the stock market more like a video game, in the sense that they just think, I'm going to put money over here and I want my money to go up, not down. They're not thinking that, okay, I'm buying a piece of a business, and to take it a step further, I'm buying revenue. I'm buying profit. Now, it might not be today's profit, but it's the future profit I'm buying a stream of cash flow, whether it's now or in the future. I'm not just playing this video game where I take some digits from over here and put them over here because I want some bonus points for those digits to go up before I put them back over here. You're actually buying people, human capital. You're buying a balance sheet. You're buying a revenue stream. You're buying an actual business. When you're trying to explain that or encourage people look at it from that standpoint, how do you do that, whether it's in your videos or to friends and family?
Well, I think, to answer your question, I think that everyone knows that the stock market, or maybe not everyone knows this, all it is a discounting machine. So when you see Tesla explode like it did a couple of weeks ago, people are saying that, well, they have the solar panel business, they have the car business, they have all these different facets of their business. So you're just discounting that back into the price of the stock. However, I think to your point, people have gotten so used to the video game pixels on a screen mentality that they really don't realize that they are investing in a tangible business that typically sells tangible goods.
Right.
And those goods could be at the mercy of cycles. It could be at the mercy of interest rates. It could be at the mercy of government policy, history, economics. All that plays a role. And that's why when you try and explain these things to people who maybe aren't familiar with finance or familiar with publicly traded companies, the way I like to keep it simple is just by saying, if I'm offering quote unquote investment advice, if we're just having a beer at the bar, I always recommend getting into companies that are blue chips, that have very defensive products, and that aren't always at the whim of the markets. So if you're thinking more defensive, think of like consumer staples, think of things that you use every day. And I try and plant that in the seed of the brain of the person that I'm talking to, saying like, hey, do you use toilet paper? Do you use toothpaste? Do you use mouthwash? Things like that. And that gets them starting to think like, oh, they connect Palmolive or Colgate or whatever to Procter & Gamble, for example. And that gets them thinking like, okay, these products that I use every day are really related to an actual company. And that's kind of how you build the foundation. Obviously, if someone doesn't have any formal financial education or training, it's kind of hard to dive right into, the 10Ks and the balance sheets and the income statements and all that stuff, because it just seems intimidating. So I try and make the connection in their brain between real life Nike running shoes and Nike stock. That seems to be the easiest way to do that.
I know you start from the bottoms up, but you're such a smart guy that you pay attention to the macro as well. And what do you look at as far as indicators when you're trying to figure out what to invest in from a tops down? Do you look at the CAPE ratio, or what do you look at?
Yeah, so CAPE ratio, which has obviously been way out of whack over the past couple of years. I like looking at macro. I like looking at politics, to be honest. I try and connect all the dots. So I'm not sure if this is the time or place to speak like this, but when you look at all the things that the United States does, whether it's geopolitically, whether it's with NATO, whether it's with war, whether it's with macroeconomics, all of that is connected. And people that don't realize that politics and finance and social media and the news, it all shapes public opinion, and it all shapes what certain things are going to do. Right. So take like Lockheed Martin, for example. Well, there's a reason why their stock tends to go up during, the endless wars in the Middle East, or when you look at why oil is traded in dollars, aka the petrodollar. All of these things affect other things, and we have become such a globalized world that everything affects everything at this point. So I don't know if I answered your question from a technical standpoint of ratios and things like that, but I like to look at Twitter and see what the sentiment is online from all the financial people who I respect. And then I kind of form my own opinion, thinking big picture from a 3 to 5 to 10 year perspective.
That's really interesting. Do you ever go on Twitter or try to see what the public is doing just to fade it?
Good question. I think that you have to be careful of just forming your opinion based solely on social media.
Right.
You kind of have to gather all the information at once and then just form your own educated opinion. A lot of people are looking at cryptocurrency now, especially after, coronavirus and the attack on Iran and all that stuff, just because they are having less and less faith in fiat or government issued currency. That's why you see those spikes. Those spikes happen for a reason. They're not just happening because, someone licked their finger and, saw which way the wind was blowing. They're happening because of things that are actually happening in the real world.
Yeah, it's just going back to your point. There's so many different cross currents, aren't there? And it's like people pay attention to just one wave, and they think that wave is just going to dominate everything else. But they don't understand that they've got all these other forces that are coming at them, and it's about determining the probability of which wave will overcome all the other waves. And it's just this complex system that's so intricate. The best way that I've ever been able to look at markets, in my opinion, is just like nature, and that it's so complex, and you have this butterfly effect that just one little thing over here could have all of these thousands and millions of effects on something on the complete opposite side of the globe. And that's where putting all the pieces of the puzzle together. But my point is that I think so many investors just get this tunnel vision on just focusing in on one thing. And I'll pick on Tesla here. And I'm not saying that their cars are bad or anything like that. There's plenty of YouTube videos on the good and bad of Tesla. But so many people just get fixated on like autonomous driving or taxis. And that's all, they just get this tunnel vision, and they forget all these other cross currents.
Yeah, there could be government regulation that makes, all gas combustion engines illegal in 10 years, or it could go the other way around. You just never know. So to your point with the butterfly effect, I always look at kind of like the world wars, just to go back, maybe 80 years at this point. If you look at World War I, about 100 years ago now, basically all it took was one assassination in the Balkans to get the entire world into a 3 or 4 year war. And that affected markets, it affected demographics, it affected everything. Then you look at World War II, then you look at the baby boomer demographics, how they're affecting housing prices. It's all an interconnected web of information. I think the more that you educate yourself, the more you can see the macro trends in the future.
Yeah. And then World War II, Weimar, Germany, Hitler, World War II, World War II, Bretton Woods, the Eurodollar system, 1971. That video I did the other day was taking it just from Bretton Woods to what we have today. And I was analyzing Jeff Snyder's opinion that the system, the global monetary system, is broken. And we saw it crack in the GFC. but it's still broken today. And the
Yeah.
repo spikes and other things are just symptoms of this underlying problem that's never been solved. It goes back to Bretton Woods, but to your point, you take it back to just one assassination in the middle of Europe. It's just crazy how that works. So I want to get your take on what you do and what you suggest to kind of limit your downside. To your point, the CAPE ratio, I think it's only been at these levels maybe 2 or 3 times since 1900, and it's very high, I think over 30. And so there is quite a bit of downside. The market is expensive. It's tough to find things that are cheap. So how do you limit your downside?
Yeah, so I think that so the way I have to present my information, I can talk about me personally, I can talk about what I recommend to my audience. It just depends on what kind of person you are, because personal finance is obviously personal.
Right.
So if you're someone who wants to be, living a normal middle class life, like in the Midwest, you have a couple cars, couple kids, you go to church, whatever. I know it's a bad thing in 2020 now, but
no, not on this channel, man. Not on this channel.
Yeah,
No way.
I'll joke you aside. If you want to live a normal middle class life, I recommend people just be, somewhat conservative, somewhat defensive. You always want to have a 3 to 6 month emergency fund. I know that sounds corny and cliche, but it really does help in case of, health or an accident or whatever life throws at you. And then ultimately, you just need to follow someone. I hate to say this, but if you want to live a middle class life, follow Dave Ramsey. He's got great 7 baby steps. But a lot of his advice does talk about investing in mutual funds, which are ultimately equities. Now, it depends on where your audience wants to go with this. If they are adverse or if they're kind of cautious about equities, especially in 2020, where asset prices do seem to be inflated for sure, precious metals has always historically been used as money. I just got done reading the Bitcoin Standard. It's a great book. It talks about what money is, what's been used as money, and the hardness of money and things like that, which I'm not going to go into. But ultimately, precious metals have always held up through tumultuous times. So always have a percentage of your portfolio in gold, not necessarily silver. And the only reason I say that is just because that's become more of a commoditized industrial good as opposed to a form of money. And it can tarnish and things like that. But I'd say have a portion of your portfolio in gold and then also in tangible assets if you really want to go down that route. And what I mean by tangible assets is, say you're a car aficionado and you know that this type of Porsche is going to go up in value in 20 years and it's going to not only surpass inflation, but you're going to make 10, 20% when you sell that car in 20 years. That's not the model for most people, but that is a form of an investment. Same thing with real estate. You can have tangible property. You can be in a nice B-, C+ rental neighborhood. You're not in the middle of gang wars, and you can ultimately, leverage that home, put down 20, 25, 30%, put a little bit of money into it, and you can find a solid tenant, and that could be a form of income in your retirement. There's a million different ways. You can build a business. You can start a YouTube channel. But again, that may not necessarily apply to someone who's kind of like your middle class, regular Joe living in the Rust Belt, for example. So I think it all depends on who you're talking to and what audience you're talking to. Now, if you're talking to someone who has a personality of maybe such as yourself or mine, who's maybe a little bit more open to risk and maybe a little bit more entrepreneurial, if you will, then you can recommend other options. But for the everyday person, a little bit of gold, a little bit of tangible assets such as real estate or collectible items. And then, I do have a decent portion of my net worth in equities, but that's because they're in tax sheltered retirement accounts. If you want to transition into self-directed IRAs, where you can still have an individual retirement account, you can still invest in all these things that I'm mentioning. So collectibles, precious metals, real estate, that can all be put into a tax-deferred, self-directed IRA as well.
Everyone knows this that's watching, but I do not like Dave Ramsey at all. And I want to be very clear to anyone out there that wants personal finance advice, because let me be clear. I do think that, no consumer debt and whatnot. I think that is very smart and very prudent. But if you want real financial advice, go to Marko's channel. Listen to Marko. Don't listen to Dave Ramsey. Don't listen to that guy. But
thank you.
I want to get your opinion on what I like to do. I'll just ask you a selfish question here.
Sure.
if I've got a portfolio, I like to set it up in buckets. And the three buckets that I have in my mind is insurance, investment, and speculation.
Yep.
And the way I define that is if it's an investment, it's got to pay me to own it. If it's a speculation, well, then I'm betting that the price is just going to go up or down. And I like to, and then insurance for me is just gold, because it's not about, you're not going to get rich. It's just going to maintain its purchasing power, hopefully, and hedge some of the downside in the rest of your portfolio. But
That's
I like
right.
to have 80% in stuff that pays me to own it. So that would be either really modest starter homes in good neighborhoods with great school districts. Hopefully you
Yep.
can get a 1% RV ratio. I define that as 1% growth or 1% gross rents relative to your cost basis. So if you $100,000 home, you get $1,000 a month in rent, or in some really good dividend paying stocks. In the speculation, it doesn't necessarily have to pay you, but that would be like silver.
Yep.
You think that or Bitcoin. So what are your thoughts on that? And could that type of portfolio add maybe a little more padding to the downside?
Yep, I would agree with that. And the reason I didn't bring that up is just because I'm not sure how risk averse or risk tolerant your audience is. I'm personally in my SEP IRA, I'm investing using M1 Finance. I'm basically just creating a dividend income portfolio, and I'm just going to set it and forget it and take a look at it in 30 years. I mean, I'm being facetious. I'm obviously going to rebalance it and all that stuff. But, I want to have things that are paying me an income in older age. That way I don't have to worry about, having to work at McDonald's part-time, for example, in my golden years. And I'm not saying that's ever going to happen, but unfortunately that does happen to some people. So my big portion is things that pay me income. So dividend stocks, real estate, as you mentioned as well. I live in Cleveland, Ohio. Here you can buy a nice single family home for 60, 70, 80 grand. And that'll rent for $900, $1,000 a month in a decent neighborhood.
Great.
My lawyer bought after 2013. My lawyer bought 3 houses for $60,000 total, and those things rent for about $1,000 a month. Yeah. So if you pick up 5 or 6 of those, you can literally be financially free within the course of 10, 15 years of paying those off. I do like you talking about Bitcoin, because I think a lot of people are kind of underestimating. They're overestimating fiat currency and underestimating Bitcoin, and the fact that it truly is one of the most perfect forms of money ever created. It's just that the adaptability and government and regulation and all that stuff do come into play, but that is an asymmetrical investment, meaning that you're going to spend whatever, let's just call it 10 grand on a Bitcoin, but in 20, 30 years, who knows what that thing's going to be worth? It could be worth $1 million for all we know, to where we're not even going to be talking about Bitcoins. We're going to be talking about fractions of a Bitcoin, such as Satoshis, for example. So I think that your portfolio setup is probably closer to what I'm aligned with. You have your 80% bringing you income. You have 10% speculative, 10% insurance, for example.
Yeah. And I want to point out to my viewers, when Marko is going in there and buying these dividend stocks, he's buying the cash flow. That's what he's buying. It's almost like buying an annuity.
Correct.
So because a lot of the viewers will say, oh, Marko, that's crazy, because it could go down by 50%, and it very well could, and it could never recover. We could go into Japan. And I personally, I don't know if I'd go into US stocks, but the whole point is it's not about what I would do or what Marko would do. It's about the concept and the philosophy. And it's about understanding that you're just buying that cash flow. So like when I buy a rental property, yes, I want the downside to be as low as possible. If I can get it cheap, by all means. But I'm buying that stream of income. So the price goes down or up, for that matter, I don't really care, because it's cash flow positive. I know before we started, we talked about inflation a little bit, and then kind of dovetailing that into rental property. How do you see a 30-year fixed rate mortgage? If you can use that to buy that rental property and to secure that cash flow, what I see it in my mind is just a way to get paid to short the dollar. What do you think about that?
Yeah, and I have watched a couple of your videos where you've brought up that sentiment or that philosophy. I think that in this interest rate environment, savers are losers, period. So if you have a savings account where you're earning less than 1% or a fraction of a percent, to be quite honest, you're not keeping up with inflation, and that is a stealth tax. I firmly believe that inflation is a stealth tax that people don't realize or talk about. Second, to answer your question, I think where the interest rates are today on a 30-year mortgage, I believe it's the second lowest they've ever been since 2013, I believe. And basically, you're getting 30-year cash or 30-year a loan for 3.5% or right around there. And why wouldn't you want to leverage that? I'm not saying go crazy and buy 7 properties at once. I'm saying why not buy 1 or 2, see how they go. As long as you have the cash flow to cover the nut of the principal and interest, taxes, insurance, et cetera, why wouldn't you do that? Because real estate is powerful, and you obviously know this, but you're getting principal pay down, you're getting tax benefits, you're getting potential appreciation, and you're also getting that monthly stream of income. So it's kind of like my philosophy with my SEP IRA, buying the income from those dividend stocks, whether they go up or down, whatever, as long as they can keep paying me a consistent amount. But I'm paying after-tax dollars before tax dollars with those stocks. What you're doing is you're paying 20% or 25% down to control an asset that is 100 grand, for example, if you're using that $100,000 house, for example. So I know I go on these tangents. I hope your audience is following me. But basically what I'm trying to say is with real estate, you have the power of leverage. And if you utilize it properly, debt is simply a tool. And this is one of the 2 things I disagree with Dave Ramsey about. If you're leveraging good debt into an investment that's bringing you money, why wouldn't you want to do that? Your cash on cash return is higher. All the numbers are higher, as opposed to just burying equity in the walls and paying 100% down and buying the house with cash, if that makes sense.
Yeah, absolutely. 100%. What do you think about house hacking?
I think it's the fastest way to build wealth for young people in this country, period. So my wife is Eastern European. I'm Eastern European. I mean, I'm American. We're both born here, but we come from immigrant families in Cleveland, Pittsburgh, Detroit, Chicago. These are all old school, Rust Belt cities. That's what old school immigrants used to do. They'd live in a double, upstairs, downstairs, or side to side. And until you finally start making more money, then you move to the suburbs. I think a lot of millennials need to start adopting that old school mentality to build their wealth. And my grandparents, when they came here, they weren't buried in student loans. They weren't buried with consumer debt. They weren't buried in car loans. So I think that in this day and age, house hacking is the fastest way to build wealth in the United States for a young person.
I could not agree more. When you take a look at everyone's number one expense, it's their housing cost, whether it's a mortgage or rent. And if you can just defer that, or if you can just have someone else pay that for you, then you take that same amount of money and invest it at just even a 5-6% return over 30-35 years. That's your retirement right there, even if you don't take out any equity and reinvest. It's just a no-brainer.
That's right. I agree 100%.
Let's get on to the 401k IRA. And this is a huge question, and I get it over and over and over again. Number one, how do these things work? And number two, if I've got a 401k, can I invest in gold? Can I invest in real estate? Can I invest in Bitcoin? And then you can correct me if I'm wrong, but I think there's some forms of an IRA or 401k that you just can't touch. So if they have to be in the market, then what do they do if they're really worried about the market going down? Inflation, deflation? Is it just go into dividend stocks and kind of keep your fingers crossed? And then my last follow-up to that would be, can they go into cash in those IRAs and 401s that are restricted, or at least a portion of that? And if so, how would you suggest they hold that cash?
Yeah, so good question. Just real quick, talking about the cash portion very quickly. And first and foremost, I have not been in the retirement game, or at least from the advising side of things, for many years. So I'm probably not going to be 110% expert on this, but I can elaborate on everything that you just asked.
Great.
So where I would hold cash, if you're looking at something that's going to be short term. So say, for example, you and your wife are pregnant, you want to have a kid, and you need to buy a house within 1 or 2 years, for example. I would keep that kind of money in a money market account. That's where my wife and I have our house fund. We're earning about 1.6%, I believe, right now, which is close to inflation. Whether it's true or not, that's what you're led to believe. You're led to believe that the CPI goes up about 2% a year. So to keep cash, I keep it in money markets. I know some people keep them in T-bills, as you mentioned in your channel. At this point right now, it's set it and forget it. It's automated. I'm happy with where we have it. Now, if you want to go into the retirement portion of your question, the way I break these things down on my channel is basically like this. Again, if you're just the regular middle-class person and you need to save for retirement and you don't know what else to do, a 401k with your employer's match is probably the best thing that you can do, just because that's how the system is designed. Okay. This isn't for people that are thinking of alternative investments, thinking outside the box, buying collectible cars and real estate and things like that. This is for, Betty, who's working 8 to 5 that needs to park her money somewhere, right? Because she no longer has a state pension or government pension. So for a 401k like that, I always recommend the people to contribute up to what their employer matches. And if you're eligible, I would max out the Roth IRA. So yes, these are obviously mostly all in equities, depending on what you invest in. But I think for the regular middle-class person, the 401k machine, whether you want to use that word or not, that's how it's designed by the government, and it's definitely here to stay, or at least be inflated for another 10, 20 years. They need to prop it up somehow. They're not going to let it go bust. They're not going to let it turn into Enron, where everyone just loses their retirement overnight. These are people's lives, and if they're not taken care of in retirement, that's where civil unrest happens. That's where things start to really change. So for the foreseeable future, I don't have a crystal ball. I would recommend the regular middle-class person to contribute up to their employer's match, and then $6,000 a year into a Roth IRA if possible. Now, you alluded to other options, such as not being able to pick different things or different options within your 401k. That's where I would recommend researching and really peeling back layers of the onion into a self-directed IRA, which I alluded to earlier in one of my answers to your questions in this podcast. A self-directed IRA allows you to invest in many more different things than a traditional 401k that's sponsored by Vanguard, for example. You're allowed to invest in collectibles. You're allowed to invest in precious metals. You're allowed to invest in real estate. You're allowed to hold many more different things that are more creative or more alternative than you would be in a traditional employer's 401k, if that makes sense. So I'm not sure if I'm answering your question, but
absolutely. Yeah, that really answered it well. I think the majority of my viewers are going to be concerned about the market correcting, let's say, and they'd prefer to be in gold or real estate or silver. So is there a penalty if you've got maybe the traditional setup right now and you want to move it to a self-directed? How does that work?
That's a great question. And there are experts online. I'm a big fan of Bigger Pockets. You and your audience may be familiar with Bigger Pockets. There are so many self-directed IRA specialists on there that it's not even funny. Obviously, they have an ulterior motive because they want you to turn your regular 401k or traditional 401k into a self-directed. That way they can use that money to invest in real estate, for example. However, I'm not sure, and I don't want to mislead your audience. So I don't know the answer to that in terms of a rollover, but I have seen it as an option. I just don't know if there's any fees incurred with that.
Okay, let's talk about one of your most popular videos that you did, and that's on the 2020 recession. I think that you did this, or if we have a 2020 recession, I don't want to say that you're predicting that. Kind of what a good strategy for that average Joe family out there, the guy that works the 8 to 5s, got the wife, the 2.5 kids, the golden retriever, the white picket
fence,
yeah, all that stuff. So with this 2020 or potential of a recession, and whether it happens in 2020 or 2025, the bottom line is at some point in time, the U.S. is going to go into a recession again. And so I know you outlined this in your video to a certain degree, and I'd suggest everyone watching this. But from your standpoint of personal finance expertise, how would you suggest most people prepare and then navigate?
Yep. So this is going to sound again like Voldemort, aka Dave Ramsey, but ultimately, it's just getting out of stupid consumer debt. It's like, did you really need to buy the $50,000 truck? Did you really need to buy the $2,000 grill? Stuff like that. I mean, just basically be able to weather the storm. That way you can play offense once the smoke clears. Okay. So what I mean by that is get rid of all your debt, get that emergency fund if possible. And when I say all debt, I don't mean super cheap debt like a mortgage, for example. I'm talking like dumb credit card debt. So wait until the smoke clears, and then you build up that war chest to where you can then gobble up these properties for 20 cents on the dollar, 30 cents on the dollar. I don't think we're ever going to see anything like '08 ever again, where in 2012, 2013, you could literally buy houses for 30 cents on the dollar. I'm not exaggerating, in Cleveland, but it will be similar. It all depends on how long the Fed prolongs this bubble. Okay. If they prolong it, for another 5-10 years, who knows when this thing pops, what that's going to look like. But if it were to slowly decompress, kind of like when you open up a can of Coke and you slowly let the pressure off, asset prices will start to go down. And that's when you can start to make better informed investment decisions. And that's when you have that dry powder and you can pick up better deals when things are quote unquote on sale.
There's two different ways of looking at asset prices. And you can look at them in nominal terms. And if you look at the housing market in nominal terms, I would agree that we're probably not going to get down to 2012 levels again. But if you look at it in real terms, I think there is a chance. And one chart that I always use, it's just adjusted for inflation going all the way back to 1900. And when you do that, you see that there's a very specific trend line. And of course, we came right down to that trend line in 2012. And now we've shot right back up. So I think a lot of my viewers are watching us saying, oh my gosh, Marko really is light years away from George's opinion, but not so much. I think we're talking about nominal and real. And if you adjust and we're comparing apples to apples, I think we'd probably agree more than we disagree on that one.
Oh, absolutely. That's why I'm a big fan of your channel. I think you have to realize I've been catering to my audience for so long, who is more of the 8 to 5, regular W-2 Joe. So I kind of just built that into my rhetoric. But I feel like the things that you teach your audience, I'm 100% on board with for sure.
You're talking about credit card debt. And one thing that is really caught my attention, this was a couple months ago, I did a video on this, and I really didn't take a deep dive, but I noticed that interest rates have gone so low. I mean, for a 10, 12-year period there, we had zero, ZIRP, 0% interest rate policy. But credit card interest rates have not come down. In fact, correct me if I'm wrong, I think they've actually gone up. Do you have any insight as to why that may be?
I have no idea. I think it's because it's one of the most profitable items for a bank, the credit cards, and they're not making any money on the retail side. And I know the exact chart you're referencing. You have ZIRP, and then you have APRs on credit cards, which has been through the roof. You would think that they'd be more correlated or in line, but they're not. They're almost inverse, if you will. I think it's because credit cards are one of the most profitable devices for a regular bank or for a lending institution, that they just need to make money somehow, because they're not making on the retail side, that's for sure. And you're starting to see more and more branches, physical branches, closing of these Chases, these PNCs, or whatever region you're in, Wells Fargo, for example.
Why is that? Can you explain to my viewer why? I mean, you were neck deep in banking. You have all this experience. Why is it so hard for banks to make money when interest rates are this low, or we've got a super flat yield curve?
Yeah, I mean, if you just look at their business model, banks make money by lending money, period. So whatever the interest rates are, obviously it's going to affect their bottom line. They need to do more volume at lower rates to be able to make more profit. Otherwise, they can't keep the doors open for certain product types. So they may close a certain lending arm, or they may close a certain product, or they need to introduce creative products. And that's kind of when you get into Wall Street with '08, when they did CMBS crisis and, derivatives and all that stuff, which led to pretty much the world economy tanking. That's when creativity kind of leads to trouble. So when I'm talking about banking, I'm talking about like retail banking on Main Street with their vanilla products that they offer. Look at HSBC today. They're about to lay off 35,000 people over the course of 2 or 3 years, I believe. Look at Deutsche Bank. Look at all these other bigger banks that are just laying people off left and right. And we actually had a string of layoffs before I quit to work YouTube full time at the bank that I was at.
Mm.
So I'm not gonna disclose where I was at, but it is a publicly traded bank, and you saw real layoffs of real people that you know. So it's kind of scary.
What happens to the local retail bank? And I just want to point out to everyone watching, this is why unintended consequences are so important. When you're looking at whether it's the Fed manhandling interest rates or politicians doing something just to buy them votes for the next election,
Hmm.
it's just they never look at this. And we as an educated group of people have to ask ourselves, what are the unintended consequences of XYZ policy? So taking that back, we understand that that's the bank model, that they're borrowing short, lending long, they're pocketing the spread. But how on earth does that work? Number one, if the yield curve is inverted for any length of time, and number two, if we get negative interest rates.
Well, basically, if you go into a negative interest rate environment, think about it from both sides of the spectrum, as the bank, the lending institution, and also as the consumer. So as the consumer, say, for example, we're going back to that example of someone buying a house in a couple of years. There were some banks that are literally paying you to take out a mortgage. So instead of you owing the bank X amount of dollars in interest, you're paying principal and getting paid on the interest. Now, from a lending institution's perspective, how are you supposed to keep your doors open like that? You know, so at the end of the day, I think that there needs to be, that introduces, not needs to be, that introduces more and more government regulation to keep these banks afloat. And if you look at what's happening in Europe and also in Japan, especially Japan, I mean, their market has relatively been flat for 20, 30 years at this point, since the early 90s. It's proven that it hasn't worked. It's just kept the economy kind of afloat in a zombie-like fashion. So
Right.
I just feel like government gets more power in a negative interest rate environment because it's artificial. It needs to be kept afloat, if that makes sense.
Yeah, and I don't know if you saw that chart that Gunlock had the other day. I watched one of his, I think it was a webinar he did, and he compared the Japanese banking system with the European banking system and the US banking system. And
Hmm.
sure enough, as soon as Japan takes rates negative, the chart of their banking system just flatlines. As soon as the European banks go negative, their chart just flatlines. And the US is the only one that's continued to increase. And his theory was that it's just because we still have positive interest rates. But
That's right. Yeah.
yeah,
Sorry. Very quick, just to
sure.
piggyback off that point. Sorry to
Yeah.
interrupt, George. So when you look at why when I say our, I mean the United States, our equities are still doing so well, are the charts that you're alluding to are still doing so well, or at least going up in a positive trend, as opposed to Japan and the European banks. That's because we're kind of the last haven of return.
Mm.
So pretend that you're a Japanese pension fund manager. Are you going to invest in your country's negative rates? Absolutely not, because you need to guarantee a certain rate of return to your pensioners, to the people that are in your pension plan. So where are you going to go? You're going to go to the last bastion of return, which is not Europe. It's not, Australia. It's not, Asia. It's going to be the United States.
When we look at the bank business model, you see the assets, their balance sheet, the assets on one side. Okay, so that's the loans, that's the reserves. That's where they're making money. You've
Mm-hmm.
got the deposits on the other side. Those are the liabilities, and that's where they're technically having to pay out. That's their expenses. So they're having to pay the depositors, or they're having to pay for those liabilities.
Mm-hmm.
And so they're basically, the right hand side of it, or the liability side, is where they're losing money, and the left hand side, the asset side, is where they're making money. But in a negative interest rate environment, doesn't that swap to where now all of a sudden the asset side of their balance sheet is where they're losing money,
Yeah, they're
and the
paying
only way
money
they
out.
can make money is on the liability side? In other words, your deposits. Am I seeing that correctly?
I mean, from a high level standpoint, yeah. I mean, that's pretty much what it is. I think the thing with finance is that it really isn't that complicated, but it's intentionally made complicated for the everyday person to not understand it, especially when you get into Wall Street and things like that. But if you're looking at this from just an entrepreneur, business owner, common sense, assets plus liabilities equals owner's equity kind of a standpoint, yes, you're absolutely correct.
Yeah, I mean, what a bizarre upside down world that is, isn't it? I mean, my goodness, we could go on that for hours. Okay. Another question that I always get is if I'm going to be in the stock market, or in whatever capacity, what broker is the best? And I just know absolutely nothing about this. So and I know you have a free ebook on this. So I'd suggest everyone go to, is that at your website or just your channel in the description of a video, or where can they find that, Marko?
Yeah. So if you go into the description of any of my videos, if you just blow up the description or expand it, you'll see Get My Free Investing Guide. I put a lot of time and effort into creating that. It basically lists out 17 different ways that you can invest, from real estate to money market accounts to brokerages, as you're asking in this question. I list all the pros, the cons, a brief summary, and basically how to start with those different brokerages. The ones that I use personally, or at least have money in, I have money in Vanguard. That's where my Roth IRA lives. I use M1 Finance for my SEP IRA. I just did a video completely reviewing that platform. It's about a 20-minute video if you want to look at it. And then also a little bit in Robinhood and a little bit in a couple other accounts. But to answer your question, if someone's a beginner, there's a bunch of different ways that you can answer this question, because if you're a complete beginner, I recommend something like M1 Finance or Robinhood, or even like Vanguard, kind of like the old school 800-pound gorilla in the room. If you're someone who's more advanced, there are better platforms for trading options, for example, which is more of like a TD Ameritrade kind of a thing. And then you have Acorns, who just invest, like it rounds up purchases. Like you bought a cup of coffee for $3.50. It's going to turn that purchase into $4 and put that 50 cents into your investment account. And in my opinion, that's not really going to move the needle long term, but that's if you're like 18 years old and you just want to get your feet wet. So it just depends on the type of person you are. Again, I personally use Vanguard just because they've been around forever, and that's where my Roth has lived since I was pretty much earning an income. And then M1 Finance is what I'm using for my SEP IRA due to its simplicity.
I understand why the zero fee brokers are attractive. Is there a downside to that? And my concern, and we spoke about this prior to the interview, is that, I mean, how are they making up that margin? Are they selling my information? Are they selling my trades? Are you concerned about that at all? Or is that just maybe, who cares if you're just buying a couple shares of Apple and you're just going to hold it for the next 20 years?
Yeah, that's a great question. So I can't speak to obviously every business model out there, but I know if you use like M1 Finance, for example, more and more of these robo advisors or these hybrid brokerages where they're saying like, hey, this is zero commission trades, you're not paying for any of these trades. They typically make money by turning their product into a one-stop financial shop. So say, for example, you open up an account with M1 Finance, you can not only trade, but you can also get a debit card, a checking account. You can borrow from your own account on margin. So they are earning money on basically the interest on that you're paying them. So say, for example, you have 10 grand in a trading account, you can take out up to 35%. So I can take out 3,500 and I borrow that at 3.5%, for example, which I'm paying M1 Finance. So they're now becoming a lending institution at that point. That business model I can speak about because I just reviewed M1 Finance. The other ones, I'm not sure. It's just basically assets under management, if I had to guess.
Most of the hedge fund guys that I talk to, they all use interactive brokers. Is that just because they've always used it, or is there some advantage? Or, from my standpoint, I like to consider investments outside of the United States. And so I guess a couple questions. Number one, do any of those that you suggest or outline in your book, do they give you the opportunity to invest in other markets? If so, how many, how flexible are they? And then why do you think a lot of the pros use interactive brokers?
Yeah, so interactive brokers is old school. They've been around forever. I mean, they're like one of those, Schwab, Scott Trades kind of a thing. They've been around forever. It's probably more a creature of habit than anything. And then to answer your second question about investing abroad, a lot of these, they don't necessarily allow you to invest specific securities on different markets or different, like the Nikkei, for example, or FTSE in London. But what they do have most of the time are index funds or ETFs that trade, foreign securities, that hold foreign securities. So you're not going to be able to find necessarily the next crazy, Tesla that just got listed on the Nikkei in Japan. However, that could be included in a bundle of stocks in an ETF or an index fund, for example.
Right. Got it.
Yeah, but it all depends on the platform. I'm just talking about some of the more popular ones. They may not have the selection that a specific old school brokerage may offer, for example.
Okay. So for the average person out there, the guy that's working 8 to 5, and we talked about that guy or gal before, from a personal finance standpoint, what do you think the biggest mistakes that people make are? What do you think your best advice for them would be?
Yeah, if we're talking just regular Joe, 8 to 5, living a normal life, living in America, we buy too much stuff. We buy too much crap. We are a subliminally marketed to consumeristic society that needs to buy the newest thing to impress our neighbors. Whether it's as vain as that or shallow as that, it may not be. I'm just making an example. I'm being facetious, but we buy too much stuff, and it's becoming more and more frictionless, especially with like Amazon Prime and one-click shopping, and you don't even think about it. You just buy the $30 item without thinking about it. And I think once people actually start looking at how many of those things they buy throughout the year, I think they'll be somewhat surprised that they actually spent that much money.
Okay, and then from a macro standpoint, and I want to reiterate that Marko's specialty is personal finance, but don't let that fool you. This is a young guy, but he really, really gets the big picture. And so few people on YouTube understand that. And then fewer young people do, because they just haven't had the experience. They're wickedly smart, but they just haven't, lived through it. So from your view, macro, what do you see playing out in the next 10 years? I know the next 2 months is just impossible to forecast, but as far as inflation, the dollar, the stock market, interest rates, probably gold, silver, which is what a lot of people that watch this channel are into, or Bitcoin. How do you see that if you had to put the probabilities? Nothing's for certain, but just probabilities. Where do you see that in 10 years?
Yeah. So if you want to go super crazy, low probability, but just to get your viewers kind of like thinking, get their noodle churning.
Yeah.
What happens when the dollar is no longer the world's reserve currency, or oil is no longer traded in dollars? What happens then? I think that the United States is getting away with all the money printing, especially in the repo markets that we've seen since September. They're getting away with that because the petrodollar exists. The dollar is the world's reserve currency. So instead of being Zimbabwe, where we just print billions of dollars and our currency is worth nothing as paper, we've seen 2% inflation.
Right.
So my point to that is that we're allowed to get away with money printing just because we are the world's reserve currency, and we are oil is traded in dollars. Now, what happens if that stops? So that's just the big question I'll leave everyone with.
All right, buddy. Well, I sure appreciate your time, Marko, and I'm looking forward to doing this again. I love to get your perspective, and just the side of this that I really don't pay any attention to. So I want to thank you for your time, and I really appreciate you coming on the Rebel Capitalist Show.
Yeah, my pleasure, George. Thank you so much for having me. I hope to talk to you again in the future. Thank you.